Prakash sir?
Yes, ma'am.
Sir, you can play the screen, sir. Our browser screen is there, so that you can play behind.
Sorry, ma'am.
So the posters which I've sent it to you now, sir.
Good afternoon, ma'am.
Good afternoon, sir. Good afternoon, sir. Very good afternoon, sir. Prakash sir, our resource person is joined. You can make sir as a host also, sir, as well.
Yes,
Tamarai
yes,
Selvan, Mr. Tamarai Selvan. Prakash sir, can you able to see?
Yeah.
Please, sir.
Chitra ma'am, you want to keep the video or?
Sir, it's up to you. You can. It's your convenience, sir. You can make. You can. You can do it
Okay, I'll keep the
however you
video.
want. Yes, please.
Yeah.
It's left to you, sir. It's better actually both if it is there, and you can. It's up to you, sir.
Yeah, please let me know when we can start.
Sir, 1 more minute, sir. We'll start. Just a minute, sir. Prakash sir, our directors are joined.
Yes, ma'am.
Our director sir is joined.
Yeah.
So shall we start, sir? Then?
Yes, ma'am.
Sweta and Arpana. I'm going to start. Sir, I'm going to start, sir.
Yes, ma'am.
A very good afternoon and a warm welcome to all. I, Dr. S. Chitra Devi, Associate Professor at the Oxford College of Business Management, welcome you all for a workshop on rebounds of insurance sector during pandemic, organized by the PG Department of the Oxford College of Business Management. The Oxford College of Business Management, under the aegis of Children's Education Society, has transformed itself from most humble blessings into one of the most vibrant groups in academics, sports, arts, culture, and discipline. The inspiration behind this is our founder chairman, Sri Narasaraju Garu. The chairman of the Oxford Education Institution, Sri S.N. V.L. Narasimharaju Garu, has been a constant source of inspiration and support for the faculty and students. I thank our chairman, sir, for giving us an opportunity for conducting this workshop. I would like to extend a warm welcome to our respected director, Professor Dr. Jacob Alexander, who has been guiding us and inspiring us throughout this event. I welcome you, sir. It is with special excitement that I'm pleased to welcome Mr. Tamarai Selvan to a workshop on rebounds of insurance sector during pandemic. He has 21 years of experience in life insurance with domain expertise in underwriting, new business operation, process automation, and claims management. He has worked with GE Financial Insurance, MetLife Insurance, Reliance Life Insurance, Aviva Life Insurance, and Exide Life Insurance in various geographical areas like Delhi, Mumbai, Pune, Bangalore, and Chennai. He has conducted several sessions during the pandemic to help people to understand the importance of insurance during this current scenario. His knowledge has helped many to decide about the correct investment plan. We welcome you, sir, for the workshop. I hope all the participants will be benefited through this program, as insurance is very important area where people should have complete knowledge before taking up a policy. Over to you, sir. The session is all yours.
Good afternoon, everyone. Thank you so much, Chitra ma'am, for the nice introduction. Thank you to Oxford College of Business Management for giving me this opportunity to share my view of how the insurance sector is rebounding during the pandemic. Before we start, there are quick quick things which I want to update. One is the question and answer session is there at the end, so you can note down your questions so that we will take it up at the end. I would request everyone to put your session on mute so that we can have a fruitful session. We will start the session now. So this is the agenda for the session. So the agenda is to cover what is the need for insurance. Basic principles of insurance. why and what is underwriting. So that is my expertise. I've been into underwriting for more than 15 years now. So type of underwriting decisions, what are the different types of underwriting decisions, and what are the types of risks which are there in the insurance sectors, and pre and post pandemic, how insurance is, and what is the need for insurance pre and post pandemic, and why need for insurance is increasing during pandemic. That is something which we will really be looking forward in terms of how insurance plays an important role during pandemic. So then what is the conclusion? So this is I would say that this is my viewpoint on the conclusion. So so this is something which we will talk about, and at the end we will have the question and answer session, so that we'll have open house on the question. Okay, so moving forward, what is the need for insurance? So there are different types of insurance, life, fire insurance, motor insurance, health insurance. So these are different types of insurance which are available. The basic objective of any of these, different types of insurance are the same. So one is to protect the financial loss. Okay, in terms of life insurance, the objective of life insurance is to protect the financial loss of the breadwinner. Okay, so in a family, typically, breadwinner, in the Indian scenario is father. Okay, and in case of any loss, to the breadwinner, how do the family gets protected? And it could be because of the saving, but the saving will not help the family to have a same standard of living, to have the same kind of expenditure management over a period of time. So insurance is one of the solutions. I wouldn't say that it's the only solution. So insurance is one of the solution for them to protect the financial loss of the family. So there are different types of insurance within life insurance. So one is the term life insurance, the second is endowment, the third is unit link, and the fourth is annuity plans. So what we are talking here on this particular point is how the term life insurance and insurance which has a life cover will really protect the financial loss of the breadwinner. The second is how the business gets protected from an unforeseen loss. So you might have seen in the pandemic that a lot of businesses are under losses. Okay, so they are shutting down, or they are reducing the operations. So this is a kind of unforeseen loss, because no one has expected that there is a lockdown. People will not be able to spend money. So if you look at insurance is one of the solution to protect the losses. But if you ask me whether a pandemic or catastrophic loss is protected by way of insurance, yes, definitely. There are specific insurance for that. So business loss can be protected by way of insuring the unforeseen losses, unforeseen risk. So for example, if a small organization or a small business setup, who is running a business with around 10 people, so they can have a insurance. There are two types of insurance they can have. One is the insurance to protect the business loss. Second is to protect the people who are there running the business. So if you look at a smaller business setup, there will be a key person who will be running the business. So if the key person is not there, then that the business is under loss, because there is no one to strategize the business, to take forward the business. So here the protection here, what we are talking about is to protect the individual. So if the individual who is a key person, who is the driving force behind the business, is not available, then there is definitely a loss to the business. So the life insurance cover on that, a key person will really help them to bridge the gap of the losses. The third part is the bridge the emotional loss. So it is something which is quite debatable, because how do you measure the emotional loss? Because while emotions cannot be measured, but the insurance to bridge the emotional loss is only portion of the loss which gets lost. So I completely agree that you cannot have a quantifiable loss estimate on that, but there are few losses in terms of emotional loss which can be put in across as an insurance. So if you look at some of the developed countries, they have a loss, they have insurance, they have pet insurance as well. So pet insurance is also something which covers the emotional loss, because there are people who go into depression because they lose their loved ones. So there will be a income loss in between. So this insurance is known as the income protection insurance. So when they are not actively at work, and when they are at depression, or when they are in a phase where they are unable to work, so the income protection insurance comes into picture. So the last point here in this slide is backup for catastrophic and pandemic or any other unforeseen losses. So insurance is definitely a backup. It's not a complete solution, but any catastrophic loss or a pandemic business loss is something which is really which is temporary, and it takes some time for the business to come back to normalcy. So the insurance is really helping them to bridge the gap between between the unforeseen losses, and by the time they set up the business again, and then come back, bounce back on the business. So so moving on, so what are the okay, so just to talk about some basics of insurance. Okay, what are the basic principles of insurance? So we know that the insurance is something which cannot be, which is a product which is not seen. So we call insurance as an intangible product. Okay, so why do we call insurance as an intangible product? Is because it's a contract, it's an agreement between two parties. Okay, one is a company, which is an insurance company, and second is an individual or an organization. But like you buy a phone, you buy a grocery, there is no product which is involved here. Okay, it's only a contract between two people, and the contract and the promise is to deliver the promise when the loss happens, or when it is required to be compensated. So these are some of the principles of insurance. Since it's a intangible product, there are some principles which are guiding principles which are there for the product. So the first and the foremost basic principle is the insurable interest. Okay, what is the meaning of insurable interest in simple terms? Is a loss within the family, like husband's loss. So wife is at loss because of the husband's financial loss. So insurable interest is nothing but at the loss of one person, whether the other person has any interest. So, the other example which is not suiting the insurable interest is, a neighbor taking insurance on his neighbor. So, a neighbor is not under financial loss on death of the other person. So that is something which, doesn't have insurable interest. So, these are some of the guiding principles. So insurable interest is the basic principle of insurance. Okay, the second basic principle of insurance is, moral hazard. Okay, so why do people take insurances to compensate, the loss? Okay, be it a life loss or property damage or accidental loss, accidental damage. Okay, so these are the losses which the insurance companies compensate, but there is something known as a moral hazard, which comes as an element of anti-selection. So anti-selection is nothing but someone is trying to make a person more worth at his death than when he is alive. So let me give you a quick example if this is confusing. So quick example is a person who is earning 5 lakhs per annum. Okay, he has taken an insurance of around 3 crores. Okay, so a person whose worth of 3 crores on his death, and even if he works for 10 years, he'll be able to earn around 50 lakhs. So, so is there a moral hazard? Is there a risk on his life? Yeah, definitely there is a risk on his life, because, someone who knows that he has insurance worth of 3 crores, but, even after working for 10 years, he'll be able to earn, around 50 lakhs. So there is definitely a life risk which is involved for him. So this is what is known as a moral hazard. So if we know a person is worth more dead than alive, then a person might be killed for his insurance policy. So in the slides to come, I'll tell you how this moral hazard is eliminated. So the basic basic way to screen this moral hazard is underwriting. So we will talk about it in the coming slides. So the other important aspects of principle of insurance is earned and unearned income. Okay, what is the meaning of unearned income? You might have heard about income, but the income is categorized into earned and unearned income. So if a person who is earning money through a business, or through a teaching profession, or through going to a job as a software profession, so these are the earned income, because the person has to go to a job, he has to do a particular job, and then he earns income. So that is known as a earned income. So on the contrary, if you ask me what is the unearned income, these are income which are which comes in whether the individual is performing the activity or not, performing the job or not. So for example, income out of property, rental income, these are unearned income. Okay, so how these income are generated is only by way of the property, not by way of the individual performing any act. So the other unearned income is pension income. The third unearned income, one of the example of unearned income is interest income from deposit, interest income from deposits. So how the unearned income forms part of the principles of insurance is if a person is applying for, this is in line with the moral hazard. So if a person who's who's applying for a term life insurance is nothing but when the person is there, or if the person is not there, the family has to be compensated for that financial loss. So here, a person who's getting an unearned income, even if the property is in my name, if the rental income comes in, the rental income can be enjoyed by the family even if I'm not there. So the question here might be that how the tenants will give the income if the house owner is not there. But if the house owner is not there, his family will still continue to get the income, because the agreement is still active. Having said that, a term life insurance is nothing but a replacement of income. So basis the principles of insurance, if you ask me whether a term life insurance, pure term life insurance, this is a terminology which is used. So whether a pure term life insurance can be given on a life assured who has unearned income, no, we won't be able to give a term life insurance on a person who has an unearned income. So that is how it forms as the principles of insurance.
Hello, sir? Hello? Sir? Prakash, sir?
Yes, ma'am.
So the voice is not clear. Voice is not
Sorry,
clear.
I got disconnected. Just
Not a little clear, yeah. Voice is breaking in between.
That's what. Sir got disconnected since he's joining.
Now it's clear, ma'am.
Okay, sir. Okay, sir.
Yeah, I think the call got dropped in between. Yeah, should we continue?
Okay, sir. Yes, sir. You can continue, sir. You can continue.
Yeah.
Yes, sir.
Yeah.
Yes.
Okay, so we were talking about beneficial owner. So beneficial owner is nothing but the person who gets compensated at the time of the claim. So that is something and like I said, the beneficial owner differs from what is a business setup all about. So in case of a life insurance, the beneficial owner is a nominee. Okay, in case of a business setup, the business owner, is a beneficial owner. Okay, so moving on, why and what is underwriting? We talked about, the principles of insurance, wherein, there was a point on, how, important to ascertain the model asset. Okay, so one of the primary function within any kind of insurance is underwriting. Okay, so in simple words, the underwriting is nothing but approving authority. So that is what the simple words, if I have to put it in simple words. So the underwriting is a process of identifying, analyzing, classifying, and selecting the acceptable and calculative risk. Okay, so what is this all about? The process of identifying the risk is done by the underwriters. Typically what underwriter does is to identify whether a risk is of a low, medium, or high risk. Okay, so for example, if a person who is applying for a 3 crore of sum assured, okay, the example which I have given, I'll go back to that example. A person is applying for a 3 crore of insurance cover, and his earning is 5 lakhs per annum. And the life assured is around 50 years old. So here, the underwriter identifies this risk as low, medium, and high risk. Okay, so looking at this 50 years old, 3 crores, and earning 5 lakhs, it is identified as one of the high risk. Okay, second is the underwriter analyzes the risk. How do the risk gets analyzed? Okay, so there are different ways of analyzing the risk. Okay, the one of the evidence-based analysis of the risk, which is what the underwriter does. The underwriter doesn't use this here, but it is completely based on his evidences. Okay, the evidences here are the proposal form which is given by the client. Okay, the financial documents, the salary slip, and other financial documents given by the client. Okay, the income declaration which is given by the client. Okay, the medical findings. Okay, the client also gives whether he has undergone any any surgery, or if he has had any kind of adversity, medical adversity. So those are the informations which are given. Okay, the client also talks about for how long he is living in that place, whether he is living in a place which is of high risk or low risk or medium risk. So based on the location, so these are the information which are available to the underwriter, and the underwriter analyzes the risk, okay, based on this. So that is what the analyzing factor of the underwriter. Okay, so once the risk is analyzed, okay, the underwriter classifies the risk. Okay, how do the underwriter classify the risk? In the example what I've given, let's take medical as an example. The client has mentioned that he is suffering from diabetes for the last 10 years. Okay, 50 years old, suffering from diabetes for the last 10 years. So the risk is classified as a substandard risk. Substandard risk is not a standard risk, wherein the underwriter classifies this as a high risk from the medical viewpoint. Okay, so the client is considered as a substandard risk from the health viewpoint. So that is what the classification, that is one of the example of the classification the underwriter does. The other classification the underwriter does is whether the client has a capacity to pay the premium. So the other classification is the financial risk classification. Okay, so the underwriter also does the financial risk classification by going through the financial documents given, by going through the payslip given. Okay, so that is what the classification. The final step, before taking the final decision, is the selection of the risk. So what is the meaning of selection of the risk is, as per the guideline of the company, there are different guidelines which are there within every insurance company. It is not the guideline which is given by the insurance regulator. Every insurance company makes their own guidelines based on their experience, claims experience, new business experience, based on their business numbers. So the underwriter uses the guidelines to select the risk or not to select the risk. Okay, this is nothing but acceptance and rejection, which is the last step of the underwriting. There are different decisions which the underwriter takes, which comes in the next slides. So the underwriter finally accepts the risk based on these 4 steps. Okay, there could be 6 steps, 8 steps, but these are the 4 major steps which the underwriter takes to identify, analyze, classify, and select a particular risk. Okay, so moving on. Okay, what are the different types of underwriting decision? Okay, I'll just go to the previous slide. Okay, so the underwriting is done. Okay, so one of the steps before the policy gets issued is underwriting. Okay, what are the different decisions the underwriter gives? Okay, this is something which is much more important from the final decision viewpoint, because any insurance policy, be it health insurance, life insurance, motor insurance, or general insurance, the underwriting happens either at the before the policy gets issued, or at the time of claims. Okay, in terms of a health insurance, the underwriting happens at the time of claims. In terms of a motor insurance, the underwriting happens at the time of claim. In terms of a life insurance, the underwriting happens, before the policy is issued. Okay, so what are the different decisions the underwriter takes? Okay, the first decision is standard. Okay, everything is clear, based on the earlier step. So the policy gets issued. Second is substandard. Okay, so the substandard decision could be because of health reason, because of occupation, because of the place the client is staying. Okay, the next decision is decline. Okay, so the underwriters sees that this is a high risk, so the underwriter has declined the case. Okay, so when we decline a particular risk, okay, the money goes back to the client. So decline could be because of medical reason, okay, or it could be because financially the client is not eligible for the cover. Or it could be that the client is over insured, he already has enough of insurance. Okay, the next decision is postpone. Okay, so this is something which the underwriter takes as a decision not to accept the risk now. So the risk can be considered later on. So typically, if you look at the current condition, current pandemic condition, the risk gets postponed. So if we know a particular client has undergone a COVID test, and if COVID test is positive, and if it comes for underwriting decision, the underwriter might say that we will consider this after 6 months or after 1 year, because the current condition of the customer is not known, or the client is not known. So that is one of the example for a postponed risk. Reject drop is similar to decline. It's only a terminology which is different. So the other thing in reject drop is client also rejects the proposal form. So client says that I don't want to continue the proposal. So in that case, the proposal will be rejected by the client. So same as drop as well. So the last decision is to call for further information. So whatever information the client has given, it's not sufficient to take a decision. So what the underwriter does is to take a decision to call for further information, so that we know that the final decision, any of those 5 earlier decision can be given. So this is what the types of decision which are given. Okay, so let's move on to the types of risks. Okay, while we talked about the principles of insurance, how the underwriting is done, and what are the decisions of underwriting, what are the different risks which are involved in all these decisions. So the first is the occupation risk. Okay, we know that every occupation is not the same. In the current pandemic situation, doctors are considered as a high risk, for any of the insurance, be it health insurance or life insurance. So, while in a normal situation, doctors are considered as one of the super HNI portfolio. Currently, if you look at health insurance and life insurance company, they are not ready to accept, doctors as a good profile. So that is one of the risks. Country of residence. Okay, if you look at in the current pandemic situation, a proposal form or a client who's applying for an insurance policy from United States of America is not considered. Although he is a HNI client, has a good has a good income, so he is not considered, because it's of a high risk when it comes to a client who is applying from United States of America. Okay, so medical risk, again, like I said, a client who is a diabetic. Okay, so our client who has undergone a heart surgery. So that is the type of risk which which gets underwritten or which gets looked at. You might be wondering, what is financial risk? So financial risk is nothing but client who is into a lending business. Okay, he has given money to a lot of people, and he is at a risk of people not giving back money to him. So that is what the financial risk which gets assessed at the time of insurance. So if a client who is applying for a business loan, a businessman who is applying for a 1 crore of loan, his financial capabilities are assessed. So that is a financial risk which a lending company looks at. Moral hazard, we talked about it at length as one of the basic principles of insurance. So I'm going to talk about family history. It's quite an interesting topic. How a family history affects what is the risk in a family history. It is known as a genetic science. So most of the developed countries are looking at the genetic history and trying to do a preventive medication. So family history risk is one of the predominant risk which is there which is there in India, but it's not something which is explored or because it requires a lot of data science. So family history risk is one of the high risk when it comes to any type of health or life insurance. The last is lifestyle. Lifestyle is nothing but a person who is addicted to alcohol, or a person who has a smoking habit, or a person who has a drug abuse, narcotics and drug abuse. So that is what the risk which gets assessed. So these are types of risks which any of the insurance company look at when before they issue an insurance policy. Okay, let's move on. Pre and post pandemic, how the risk is seen. Okay, so these are some of the points which I'm going to talk about. How the risk is seen pre and post COVID. Just to set the context here, pandemic is something which we never expected. If you look at early weeks of March, although there were news, if you ask me, we had in our company we had a meeting, with all the HODs, along with our COO, and he called for the first meeting on COVID. So I was wondering, it's not something which is really important, because it's something which is not going to affect us, is what my thought, at the first meeting. But I never expected that there'll be a complete lockdown across the country, across the globe, for that matter. So the first point here is unforeseen expenses. There are medical expenses. So if you look at a pandemic condition, no insurance companies or no health insurance companies was covering this. When we in the month of March and April. So now there are insurance companies who are covering the pandemic. There are health insurance which are there for pandemic. So if you look at pre-pandemic, there was no product for this. Now companies have seen that the medical expenses are higher, hospital expenses are higher. Hospitals are also new to this, because this is something which they have not seen earlier. So they are also trying to put that in place. So that is what the the insurance cover is all about. So the second is there are some insurance covers which are there to cover the financial losses, loss of job. So if you look at pre-pandemic condition, people were not serious about income protection. Okay, so although income protection was one of the insurance which was sold predominantly in US market and UK market, because unlike India, the job loss is quite predominant there. In India, there are different jobs and manpower requirements which are available, but in our country, the income protection insurance is something which is really picked up, especially after pandemic. So people have realized that there is a need to cover our cover our income. So income protection insurance is something which is not predominantly sold. Now it is getting a shape. Okay, so the next is, what are the so there is definitely a need. Now there is definitely an increase in the market for the term cover and health cover. So if you look at in our company, we had term insurance, which is pure term insurance cover, for ages now. But we have seen that the number of policies which are getting sold for term insurance has increased during pandemic, which was not the case earlier, because earlier people were more interested to buy a unit link plan or a savings plan for their children's studies, children's education. But now most of the people have realized that there is a need to cover the family, because if there is a sudden COVID positive for the breadwinner, then the family is left without no income. So there is definitely an increase in in the term insurance, and health insurance is a major contributor during pandemic. So people are buying health insurance, and there are specific cover which are related to COVID. So companies have come up with specific cover with a one-time premium. So that is something which has changed during pandemic. The last but definitely not the least point is how anxiety and depression is affecting people. So although it's something which is not so talked about, but if you ask me personally, there is definitely a social stigma around COVID. So if if you're staying in an apartment, and if your neighbor has a COVID positive, so then you tend to just stay indoor. And staying indoor without meeting people itself is something which creates anxiety and depression. So how do we measure the loss, or is there any insurance cover for this? Definitely, there is an insurance cover. The insurance cover is not specific to anxiety, depression, but people who are who tend to lose to a depression, which might lead to suicide also to some extent. So the insurance plans will cover their losses. So this is pre and pandemic. What are the different things? So the next is why need for insurance has increased. Definitely the risk of uncertainty. So there is an uncertainty during pandemic, because as we speak, although there is there are different unlock guidelines which is given by our government, and there are different SOPs which are circulated, but we don't know whether next month the same will continue, or in the next month, with the increase in number, the unlock guideline will be changed. So we are still in more of a uncertain situation. So the family members' life needs to be secured. The breadwinners' medical aspects needs to be secured. So that's definitely, there is definitely a need of insurance, because the risk of uncertainty is still there. So while the second point is there are typically, if you look at any of the Indian segment, the savings element is really higher, because if you look at most of the people in this group who are students. So once you are out of college, the first thing which your parents talk about is savings. Okay, don't spend money on buying cars, bikes, but you have to start saving for your future. So what happened during pandemic is people who have really saved money for their future have started spending those money on the medical expenses. Okay, so that is, and as you are aware that the hospital bills for pandemic, be it a government hospital or private hospital, the minimum expense, starts from 1 lakh, and it goes up to 5 or 6 lakhs, or in some cases it goes to 1 million as well. So it definitely ruins the savings of the people. It is required for population to take pandemic insurance. So that is why the need for insurance has increased during pandemic. So there are cashless facilities available. If you look at health insurance, the cashless facility which is given by the health insurance facility, health insurance is something which really helps any individual to get into a hospital admission, and then apply it without even spending anything on their from their pocket. They can just go and their hospital admission. So there are pre-authorization which are required. So all those are the process which are there from the health insurance viewpoint. So the last point is the income protection. We talked about it. There is a need to protect the income. So there are insurance which are there to protect the income. At the when there is a businessman who closes down the business, and if he has a huge business loss due to pandemic, there is a cover which to protect his business. Okay, these are some of the importance of insurance during pandemic. Okay, so like I said, I have put my own viewpoint as a conclusion here. Insurance is nothing but assurance. As we know that there is, like I said, there is nothing which is permanent, or which is certain here in this difficult time. But insurance is something which will really help us to give some sort of assurance that there is a backing in terms of a hospital admission, or there is a backing to my family in terms of a loss. Okay, so those are some of the good aspects. Although getting into a COVID positive hospitalization is not a good thing, but this insurance is only to protect and give assurance during the difficult time. So definitely, it is one of the options which are available. Unforeseen risk, definitely, insurance covers unforeseen risk, and it's a sense of protection. Like I said, when an individual gets COVID positive, and if he knows that I have COVID cover, health cover, then he or she feels that there is a sense of protection which is there. So even if I get into a hospital which is which doesn't ruin my savings, which has a really a good protection of my financial backing. The second, like I said, long-term savings is definitely getting protected. So this is more of a wise decision, calculative decision to protect yourself and your family during the difficult times. Having said that, there might be some thoughts on am I putting my savings into insurance? Definitely not. Okay, insurance is something which really helps you to save your protection. It's other way around, rather. Being in this industry for 2 decades, and I have seen in my personal experience, with the early loss within the family, I could make out that insurance is a better solution to protect any unforeseen loss, or protect the savings. So there are certain options available as a one-time premium as well. So if someone wants to protect themselves by paying one-time premium for the entire lifetime, or for older ages, there are insurance plans which are available. If they pay as a one-time premium, they'll be protected for up to 80 years, up to 100 years as well. There are insurance covers which are up to 100 years as well. On an average, most of the life insurance covers up to age 65 or 70. There are companies which offer up to 85 and up to 100 years as well. One-time premium is something which will not ruin the saving, as well as also it is something which really helps an individual to take a calculative risk. When they have a good saving, that saving can be put as an one-time investment, which will help us to stay protected over a period of time. So these are some of the options which are available, and these are some of the pandemic conditions, how insurance companies are bouncing back, in during pandemic. Definitely, the population in India has come to know about the need of insurance during the pandemic. And like I said, insurance is something which is a complex process. As you're aware that insurance agents traditionally, LIC is selling insurance through agents. Why do we have to give commission to someone who sells insurance? Is because it has to be explained to someone who doesn't know about the product, because the product has to be explained before you buy, because that's how the product is, because any complexities, if you want to buy a product in Amazon, you go through the review and then buy a product. But insurance is nothing but insurance is bought by taking a review from an expert who's an advisor or agent, who are also expert, and these expert are not attaining expert knowledge over a period of time, but they've been paid by the company, trained by the company to achieve this expertise. So definitely during pandemic, the insurance companies have really bounced back, and they have come up with different new products to cater to the need of the general population. So there are few so there are few questions in the chat as well. Okay, that's it from my side. So we can go to the questions, question and answer session. So what I would suggest is, probably, ma'am, if you can, put across some questions, which are there in the chat box as well. If you can, I leave it up to you to take the questions. Yeah.
Thank you, sir. Thank you for the wonderful session. The question and answer session will be handled by Dr. Arpana ma'am.
Good afternoon, sir. Thank you for the nice session. So there are a couple of questions. First question is should these businesses go in to purchase, insurance for which, any kind of a business interruption coverage should be there during this pandemic time? Is there a business interruption coverage?
Yeah, there are, if you look at some of the, non-life insurance companies, they're offering a business protection insurance cover. So typically what they do, how do they assess how do they quantify the business cover is based on the last 3 years profit and loss of the company. So they typically look at the last 3 years profit and loss and balance sheet of the company, and then they come back and give an insurance protection based on whatever be the last 3 years profit and loss of the company. So the product is available. The product covers the business losses. How the claim is settled is by assessing the production line. Basically, if you look at any of the manufacturing units, now because the manufacturing units have also scaled down, because they are not allowed to have 100% of their workforce. So they have scaled down. They have tried to maintain the social distancing. So their production has come down. So based on those things, the insurance company assess the risk and then come back and tell them that this is what the cover which we can give.
Okay, sir. Thank you. So there's another question.
Yeah.
What they've asked is, should government charge a premium for the kind of risk it bears?
So if you look at certain insurance policies, there is a default condition that they can just they can file some of the losses. If you typically look at some of the public listed companies, the listed companies have something known as investor protection kind of setup. So the investor protection cover is given by the government. So if you typically look at banks and any of the NBFCs, they have to keep a reserve with the government, with RBI. And if you look at any of the mutual fund, they have to keep a reserve with SEBI. So why do they maintain this reserve is it's not an insurance, but it's a reserve which is maintained to protect the investors' interest. So it is not an insurance cover, but it's more to do with a investor protection fund. So take some of the insurance. So if you look at a GIC, General Insurance Company. General Insurance Company is one of the largest insurer in India, and it's a government entity, and they cover most of the business, most of the government officers for their assets, for their losses, just in case if they are. So there is and General Insurance Corporation is one of the largest.
So there's this question from one Mrs. Anju.
Yeah.
Which insurance companies offers insurance at the age of 85?
Yeah. So there are. I'm sorry, I won't be able to talk about any specific name of the insurance company here, because it's really a common forum, and I won't be able to talk about my company. So there are insurance company who have as a maturity age. There are companies who have offered up to 99 years as well. So you can you can look at some of the web aggregator website. You can do a Google search on that, but there is definitely an option available up to age 85 and up to age 99 and 100 as well.
So there's a question from one Mr. Saravanan. Again, I don't know whether you'll be able to justify this. Among private sector insurance companies, which is the best one?
I'm sorry, I won't be able to comment on the private life insurance companies. If you are looking at how to buy insurance, life insurance policy, I would suggest that you can look at the claim settlement ratio. So ultimately, your insurance cover should be paid at the time of loss. So one of the important aspects is to look at the claim settlement ratio. So there are it is something which is published across the website of different companies, and it is mandatory to publish the claim settlement ratio as per the regulator, as per the IRDA regulation. So you can look at the claim settlement ratio in their website.
There's one more question. How does reinsurance generally work in this kind of a situation?
Okay, very good question. I have not covered in my slides. So reinsurers are plays a very important role in any of the insurance, because they are they are the risk partners for any of the insurance company. So let me give you a simple example here. So if I'm as an insurance company A, if I'm issuing a policy to a client for 1 crore insurance, and if there are 100 clients who have taken 1 crore of cover, okay, so it becomes 100 crores of insurance. And if my company profit in a year is 100 crores, in terms of in a condition like a pandemic condition, if those 100 people die due to COVID, then the company will make losses. So what the role of the reinsurance company is, for these 100 proposals, the insurance company pay premium to the reinsurance company in turn, and it is not collected from the clients, so from these 100 clients. But if for example, for this 1 crore of insurance cover for an individual, for example, if the client is paying around 10,000 as a premium, out of the 10,000, 1,000 rupees will be paid to the, I'm just giving as an example, this is more of a hypothetical example here. So out of the 10,000 rupees, 1,000 rupees, so if the policy is taken for 20 years, the 1,000 rupees needs to be paid by the insurance company to the reinsurance. So in case if this individual dies, for out of this 1 crore claim, so the reinsurer will pay 90 lakh, example, which I have. That is that is how the reinsurance agreement works. So the reinsurer, nothing but they take an additional risk by accepting a smaller premium from the insurance company. So this is called as a law of large number. So while the reinsurance company deal with a larger number, because every high sum assured is reinsured with the reinsurance company. So the insurance company is protected of any of those pandemic and catastrophic risks. Out of these 100 example what I've given, if all the 100 people die, then reinsurers company have the appetite to pay the claim. So here the insurance company gets protected up to a liability of 10 lakhs. Okay, so that is how the reinsurance company works. I hope that answers the question.
Yes, sir. So there's a question from one Mr. Mervin. He wants to know that which is a better, plan. Is it ULIP plans or an endowment plan? Which one do you think would be better?
Okay, so it's a very good question. So if you look at it's based on the need of the person. So there is something known as a need analysis which needs to be done before you take any of the life insurance policy. So if I have to put this into broadly into 4 different blocks of need. One is for a student. Second is for a person who is a student up to age 24, 22. Or up to age 25. The second segment is 25 to 40, third segment is 40 to 60, and fourth is 60 and above. So these are the 4 segments. And if you ask me the need of insurance for these 4 segments, the first segment, which is up to 25, there is definitely a loan protection. If you have taken any education loan, so there is definitely a loan protection which is required in this up to age 25. And here there are 2 types of insurance. One is term with return of premium or term insurance. For a person who is some 5 years old, the parents can take a endowment plan or unit link plan, so that it will be used for a future education needs of the child. So these are 2 plans, and there are some child plan which are attached in ULIP as well as endowment. So these are 2 things for this age segment. If I look at age 26 to age 40, there is definitely a need for a term insurance at this age, and the sooner you buy, the lesser you pay. So that is the first primary need of buying a term insurance. It's based on your financial capabilities. I would suggest with this increasing inflation, 1 crore should be the minimum cover. As we speak, in 2020, 1 crore should be the minimum need for you, as a term insurance. So the other need for this segment is, probably unit link and endowment. You can take on the child, or you can take on yourself, so that at the time of at 40 years, you will get a maturity amount which you can reinvest in buying property and things. So the third segment, which is 41 to 60, there are definitely a need to buy pension plan. Okay, because pension plan if you start investing on a pension fund, for the next 20 years, you really need the money at age 60. So that is something which is required. For age above 60, annuity plan is something which is, immediate annuity, because, whatever you've invested in the pension plan, you will get a lump sum, an immediate annuity, which will do a monthly return. We call this as, annuity payments. So you can go for that, in terms of above say age 60. So these are the different needs, and these are different segments of insurance. I hope this answers the question.
So there's one more question where
Yeah.
they would like to know that does these health plans cover mental health services to manage stress?
Okay. Interesting question. So if you look at the health insurance, covering mental illness is a very broad, terminology. If you look at
Probably anxiety, stress related.
if you really slice and dice the mental illness, it starts from a simple anxiety. Everyone in this group gets into anxiety, so there is no treatment or there is no medication which is required unless anxiety turns out to be a depression. So even in depression, there are different types of depression, bipolar, schizophrenia, and these are different depression which people undergo. So the question here is, do we cover mental illness? Yes, we do cover. Every company, including health insurance company, cover mental illness. Before covering, they look at what is the extent of the mental illness, what is the exact diagnosis of the mental illness. So based on that diagnosis, the cover is given. Health company typically, exclude. There is an exclusion clause in the health insurance. They typically exclude any health, any claim which are related to mental illnesses. So that is allowed as per the regulation as well.
Okay, thank you, sir.
Yeah.
Yeah, I think that's it. So thank you.
Yeah. If you have,
Good afternoon, sir.
we can take. We can take one more question if you have more questions. Yeah.
Yes, sir. Yes, sir.
Sir,
Yes, sir.
Yeah. Good
Sir?
afternoon. Yeah.
Sir,
Good
I have
afternoon.
good afternoon, sir. Sir, I have a doubt that when pricing comes to underwriting, sir, how insurance official handle the situation if he has taken 1 month before, he has not paid even one month's fees also, and if he gets suppose any accident, how do the officials handle it, sir?
Okay. Good question. So if you look at the need or the primary objective insurance company is to protect the unforeseen risk. Okay. So if a person who has applied for an insurance company, the policy is not issued. If your question is, he has not paid, he has paid the premium. So there is something known as, offer and acceptance. Paying premium is the first, basic need to get the insurance. So I'll divide this question into two parts. One is, paying the premium and policy not issued, and second is, policy issued and death has happened. Okay, so the first part is, the person has paid the premium. He has given the application form. He has given all the insurance related papers. Okay, he has just walked out of office, after the application, and then he dies in an accident. The policy is not yet issued, and the policy is not yet underwritten. Okay, in that case, the insurance company is not liable to pay this insurance cover. The second portion of this is, it is underwritten. The policy was about to get issued. Okay, before that, we came to know that we have, that it is. So the policy, the risk is accepted, but the policy is not issued. So if the risk is accepted, the company is liable to pay. So these are two scenarios where, the policy is not issued, but, risk is accepted, risk is not accepted. If risk is accepted, the insurance have to pay. If risk is not accepted, insurance companies are not liable to pay. The third scenario policy is issued, immediately there is a death which has happened due to accident or due to COVID or anything. So then the insurance companies have to pay the claim. Okay, so here this is classified as early claim. Okay, so early claim is something, as per the IRDA regulation, also any claim which happens within 3 years from the policy issuance is termed as early claim. Here we are talking about immediately 1 month or 1 day. So the claims team investigates to find out to rule out any mortal hazard, the principles and other things, which we talked about. So the goes under investigation, it goes under document verification. If it is an accidental claim, the postmortem reports are checked, all those are done, and then, the claim will be settled apparently. Yeah, I think that answers the question. Any other questions?
I think that's it, sir. That's it for today.
Yeah. Okay. Okay. So thank you so much. It was really wonderful. And the questions are quite interesting. My best wishes to all the students in this group. Thank you for joining in this difficult time.
Just a second, sir. I'll give the vote of thanks.
Yeah.
I, Dr. Shweta Bhasin, extend my heartfelt thanks to our chairman, Sri SNVL Narsimha Raju Garu, for having his extended support in every activity taken up by the Oxford College of Business Management. I thank our director, Professor Dr. Jacob Alexander, for his support and encouragement in all our endeavors. Thank you so much, sir. Now, I would like to thank our resource person, Mr. Tamrai Selvam, for sharing the knowledge with us. He enlightened us on the background of insurance and spoke very well on the need and importance of insurance. He clearly pointed out the increasing importance of insurance during pandemic and explained every aspect of this sector. The relevant examples quoted by the resource person made it easy for the participants to relate to the topic. Thank you so much, sir. Next, I express my deep gratitude to all my colleagues without whom this program would not have been successful. It is the effort of all the PG department faculties that made this workshop a great success. Last but not the least, I would like to thank all the participants who attended this program and actively participated in the workshop. This is an encouragement for us to organize many more such events in future. Thank you all for your participation. Have a great day ahead and stay safe. Thank you.
Thank you.